the disconnect between available borrowing proceeds and values and where equity gets marked, that needs to be addressed. There's not a quick fix to that unless there's, black swan event where the Fed is then forced to immediately and quickly go the other direction and cut rates drastically.
A hot topic in banking and risk is CRE, or commercial real estate. And if the loans sitting on the balance sheets of the nation's banks are under-reserved, and we're about to see a major liquidation. In today's episode, we hear from the other side of that trade. We're talking to Greg Freedman of BH3 Management, a firm that got its start buying up distressed CRE loans during the great financial crisis. We're going to get a short history lesson on the CRE market and the cyclical nature of distressed asset buying, and more importantly, whether or not he sees today as a return to 2009 as a buying opportunity for investors. Enjoy the episode. Greg, thanks for being with us today.
Thanks for having me, Rich. Great to be here.
So I think probably a good place to start is the history of the firm, like how you kind of got started in the midst of the Great Recession and kind of how that led to what you're doing today.
Sure. It's a 15-year story at this point. None of it was by design and was completely organic. It started with myself and my co-founder, Daniel Levinson, joining forces in 2009 to buy a piece of distressed debt here in Miami Beach on a Boston condo project that was about 65% complete. So it's 2009, Miami condos, three phrases that no one really wanted to hear. Both Danny and myself didn't come from money and didn't have money. And when we got introduced, we said, hey, why don't we chase this together? And we were fortuitous enough to convince one marquee institutional partner to back us on that first deal in 2009. Literally worked out of the construction trailer that was on the site with no intent of creating what we've since created over the past 15 years. We've now got 31 people between our three offices here in South Florida, Denver, and New York. Really the genesis of the firm during that period of time, called 2009 to 2012, was really just buying up distress, all whole loans, senior loans or senior and mezzanine loans, either working those out with the borrowers, getting paid off, or taking control of those assets. And in several instances that required us, building out our development team to complete those assets. And again, all organically, what came from that is coming out of that period of time, we kind of fell into the ground up development business, starting in 2013. And the firm has since gone on to deliver over 4 million square feet of primarily residential for sale or multifamily product in tri-state area in South Florida, and has another 4 million square feet on the pad right now. So we've got a fully built out development team within those 31 team members. And the firm has just continued to grow year over year, always throughout that process, not forgetting our DNA of participating in the capital stack on the debt side, whether that's performing loans or non-performing loans. And starting in 2018, or prior to 2018, every deal we'd ever done as a firm was done as a single transaction through special purpose vehicle. In 2018, we launched our first fund, primarily for the credit side of the business, participating in bridge loans and buying distressed loans. We're now in our second fund, which is called BH3 Debt Opportunity Fund 2. That's been investing and deploying capital since Q1 of last year, and really trying to take advantage of the opportunity set that we see due to the dislocation in interest rates, coupled with the banks having pulled back in the space, especially the regional banks, with the issues that they've been having, but really focusing on our share of the market and what we do best, where we bring our special sauce of not just being credit guys, but also folks that know how to build buildings and also how to deal with complex situations with our distress background.
So what was the chicken and the egg part of it? Meaning, were you looking to do the development and kind of the financing was a means to an end, or the other way around?
No, going back to that first transaction, it was us buying a piece of distressed debt, real distress, meaning we bought the senior loan, but there were 80 plus mechanics liens. It was 65% completed. There were buyers that had signed contracts to buy condos that didn't close. So a real distress of all distress situations. So from that first deal, we were in the debt, we were on the construction side, we were on the litigation side, and really cut our teeth and got thrown into the fire on that one, and basically exercising our repetitions and our muscles and learning that in real time. And that's,
And how many were with you? This is you and a partner, and how many other people
yeah,
tackling something of that size?
we had 3 other people on our team, and then we started building out our construction and development team on that first project.
I mean, wow. Just from like any one of those problems in isolation is probably a business in and of itself, but
It
handling
is.
all elements of it.
We lived in that trailer pretty much. It was a full-time job, and our view, being kind of tenacious and scrappy entrepreneurs is, you have to have a get it done attitude. If you don't know how to do it, find someone that does and learn it from them, so that you have that going forward. And every deal that we've done has just made us and the team smarter and wiser for the next one. And we've done now over 120 credit transactions. So, we've learned a lot and always continue to learn, which is what we love about our business. Every day is different.
So how does it look different today from how you structure? I mean, are you still primarily kind of coming in this, whitish knight view of, rescuing a distressed deal, or are you doing more of the development versus the credit side primarily?
Yeah. So on the development side of the business, in terms of what we do on the equity side with ground up development, that's very selective. We're looking for singular projects that, stand on their own, that just aren't a commoditized product. So we're not a firm that, commits to doing 2 or 3 or 4 new development deals a year. If anything, it's 1 or less. And that's purely an equity business. On the debt side of the business, through our fund, we're originating, sourcing, and structuring new loans, whether that's, acquisition, pre-development, construction loans, lease up to stabilization, condo inventory, et cetera. And then also within that fund, we will buy non-performing loans, which goes back to the original DNA of the firm that we've done throughout our 15-year history. But the distress environment is cyclical. Where in 2009 and 2012, there was a lot of opportunity. 2013 to 2019, not so much. And then 2019 to 2023, kind of between the wall and the wallpaper. And now, we see a tremendous uptick due to interest rates and cap rates and cost of construction on non-performing or distress opportunities. And in those scenarios, when we're buying them, we're not, a loan to own shop. We're buying it and we're sitting with borrowers and seeing if there's opportunities to restructure. And the outcomes in those scenarios are typically binary, where you're either, getting paid off, meaning the borrower has a plan and they just need some time to figure it out, whether it's a sale of the asset or bringing in new capital, or we're restructuring that deal with them to get it reperforming, or in the instance where none of those are applicable or achievable, taking control of those assets. And we're only buying debt on assets that we own, operate, know how to sell, lease, finance, et cetera.
So beyond the difference between what you as a firm do and kind of the learning curve you've gone down, what's the difference between the market, between what you saw initially when you started and what you're dealing with now, the types of deals that you're seeing now that you're looking at?
Yeah. So I'll answer in 2 parts, because there's the performing loan side and there's the distress side. So
Mhm.
I'll start in reverse order. On the distress side, what we saw, throughout the GFC was, it was just a widespread credit issue. People were highly overlevered. The banks and the debt funds at the time had done things they should not have done. And it was just across the board. And we like to think and believe that we're pretty smart group of folks here. But the reality is that when you look back in time, anyone that bought anything in 2009 in any decent market did pretty well. So, it became this rising tide environment. The distress that we're seeing today is very different. It's not a macro discussion. It is very much micro. In different markets, you could have different views on different asset classes, even block by block within certain markets on the same asset class. So today you have to be a tactician, and it's really asset by asset, borrower by borrower, tenant by tenant, in a lot of instances. And that requires a lot more data, a lot more knowledge on the ground, and an inability to kind of take general, market-wide, views on an investment strategy, because it's a difficult climate to be an investor right now. On the performing loan side, the opportunity set coming out of the GFC, what happened is there was a huge void that was left by the banks that had to pull back due to regulation, whether it was Basel or Dodd-Frank. And that created this opportunity for a lot of new entrants into the space, whether it was debt funds, private equity, et cetera, that has consistently year over year as non-traditional lenders, we'll just put them all in one bucket, have continued to take more and more market share of lending activity every year. And that's only been exacerbated as of late with the banks pulling further back, and also the regional banks having some of their own issues. So the opportunity set continues to expand for non-traditional private lenders, and the opportunity set not only due to that, but also because in a lot of their existing portfolios of other debt funds and banks, they're not getting paid off at the pace that they expected to because of interest rate creep or inability for those borrowers to refinance. So the liquidity available from even some of the private debt funds prior to 2023, rates really running, even those lenders that were very active are forced to be less active today because they're just not getting that recyclability of that capital that they thought.
So how about from your standpoint of raising capital? And again, maybe contrast the two periods in there. We see a number of headlines, particularly in the bond markets, about how much private equity, private capital has come in to kind of step into that role, particularly non-traditional structuring, things like that. But what have you seen from, you talked about raising a fund in 2018. How has that changed over time? Harder,
Yeah.
easier, a completely different animal?
So raising capital in this environment is challenging. We've had great success because our special sauce is somewhat unique where, again, we're that concentric circle between credit, development, and distress. And having that expertise in the current environment where a lot of deals require a real thorough understanding of the borrower's business plan and being able to step into those shoes if need be, which most lenders just don't typically possess that skill set or those team members. It's more credit driven than asset execution driven. And marrying those two together is not something that you can decide to just say, okay, we're going to do that now. It takes, many years of experience and going through battles and having wounds to show for it to gain that knowledge. So from us, kind of where we've been standing out and having great success on the capital formation side is those skill sets that we possess in this current environment where it's not liquid, values aren't going up, and there's not someone else to always take you out on the other side, are being proven to be really valuable. When we went out in 2018 with our first fund, we thought 2019 would be what 2023 actually was, meaning we thought that there would be interest rate pressure, that valuations had to level off or come in. And we were wrong. I mean, we were just early. And when we had those conversations in 2018 with other lender counterparties, because a lot of our deal flow comes from other lenders and other debt funds that want us in the capitalization with them. The response was, yeah, that makes a lot of sense, but kind of everything's great right now. What do we need you guys for? Because lending was a very easy business from 2010 till a year and a half ago. Because values kept going up. It didn't matter if there were misses on budgets or schedules because values went up and there's always another lender to take you out. Now, when that music starts slowing down and stop, that's when those parties realize, it's not such an easy business. And the interesting tidbit there is that when we went out with Fund One, which was really just a starter fund to kind of test this thesis that we had, that the opportunity set in 2009 for us was banks. In terms of buying distress, the opportunity set for us that we thought in 2018 and going forward and today is that you replace the word bank with debt fund because the debt funds fill that void of the banks. The debt funds are holding that paper. They're not regulated and don't have the same set of pressures that banks do. But most of those lenders were not lenders before 2010. So up until recently, they've had this euphoric experience that oh my God, this is such an easy business. And we know from, being through past cycles that it's only an easy business in a rising tide environment. It requires, real rolling up your sleeves in markets like we're experiencing now.
So at the risk of asking you to make a prediction or look in the crystal ball, if you kind of think of this like not the non-performing part of your business being maybe the canary in the coal mine, like where do you think we are in the cycle? Is this the beginning? The end is in sight?
Oh, it's a great question. It's a Billy Talent question. So we'll be the first ones to say that um, we thought the capitulation would have happened by now and started by now. It has not. It's been very episodic. And you see what happens with Signature Bank and New York Community and folks like that. But the widespread, stress or distress, or the maturity wall that we've all been talking about, has not really reared its head yet. We thought coming into 2024 that this is the year that it would have to. And what happened, early part of 2024 is everyone thought the Fed was signaling that kind of the worst is behind us and that we're going to be moving back to a low rate environment. And that just hasn't happened. And I think that that's perpetuated or prolonged what everyone knows is out there in terms of pain points, because those same folks remember in 2009, had they just been able to hold on a little bit longer, it would have been fine. And their positions would have been materially better. Here, we don't see that, meaning we think that we're in this rate environment or somewhere around this rate environment, that it's going to stay for a while. The economy is doing well, unemployment is low. Aside from us as taxpayers and the Fed being the biggest borrower, there's no other reason for there to be tremendous downward pressure on rates. And as long as that rate environment stays anywhere near where it is, the pain that exists or the disconnect between available borrowing proceeds and values and where equity gets marked, that needs to be addressed. There's not a quick fix to that unless there's, black swan event where the Fed is then forced to immediately and quickly go the other direction and cut rates drastically. But them cutting 25 bips or 75 bips over the next, couple of quarters is not going to undo the 500 basis point move, where LIBOR went from zero to what SOFR is now above 500 basis points.
So what about on the asset pricing side? Like if you look at it from the other side, from lending, do you think we're still in, dare I say the word bubble from an asset standpoint? And if so, if not, is that sustainable?
So it's a micro discussion, not a macro discussion. So I think that the V in value has come down. Folks are looking at cost of capital. They're looking at, on the equity side, meaning raising LP equity for deals is incredibly challenging because there's not real opportunity for positive carry. The game used to be, okay, we're going to buy this multifamily deal at a 5 cap and we're going to be able to borrow at 3 or 3.5%, and we have positive carry. Today, that positive carry doesn't exist. So it requires either repricing and buying that property at a cap rate that makes sense where there can be positive carry, or convincing yourself that there's going to be continued rent growth and a declining rate environment. And we've seen folks just say, well, why would I take that risk when the risk-free rate is 5%? I could go down a level or two in the risk curve and be in debt or mezz and get paid high single digits, low double digits, sometimes mid-teens, to be in a safer place in the capital stack and not take true equity risk. So I think that from an equity valuation standpoint, the good news as lenders in making new loans is values have come in, and that's across the board. It's in the corporate side as well. It's in the private equity side. Valuations have just come in because of cost of capital. But where we see those valuations going from here relies heavily upon a view that one takes on where the rate environment is going. Some are more optimistic than others. Where we sit on the credit side, we're very conservative in our approach there, and we're capped at 65% loan to value in our fund, whether it's senior or mezz. So that limits us as to how we view values and really focusing on downside protection first.
Greg, this has been a fascinating discussion. I really appreciate your insight on it. If anybody's interested more in you or BH3, where can they go to get more information?
Sure. It was a pleasure being here as well, Rich. Company website is B as in boy, H as in Harry, dash the number 3.com, and everything about the company on there.
Great. Well, we'll put a link to that in the show notes. Greg, thank you very much for being here.
Thanks for having me.